From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, August 14th. You're listening to the Macrocast. Tony Fratto with Hamilton Place Strategies coming to you from New York City. Brendan Walsh and John Fagan. You guys are still both in the D.C. area? Or still split up?
We are even more split up now. Actually, no, we're kind of reunited. We're both in Massachusetts now.
Oh, you're both in Massachusetts.
The great state of Massachusetts. Just
the different ends of it. He's on the western end, and I'm on the southern, eastern end.
Well, good place to be, and
Yep.
It's good for me to be back in New York City. Guys, there's a lot of different news this week, but we're going to take some time focus on what's going on with the Treasury market. We saw a record auction for the 30-year bond yesterday, and I don't know, John, how would you describe the reaction? Was it tepid? For a government that's got a few $1 trillion of financing ahead of it, that wasn't entirely welcome. I don't think it's overly concerning yet, but not a great sign, was it?
Yeah, the auction. Thanks, Tony. Yeah, the auction really didn't get a great marks from traders. They said demand was a little bit weak, but and as you say, this is in the course of business where the Treasury is going to have to be pushing a lot of this. Just to roll the tape back, the announcement of these of the size of the refundings, which came earlier this month, it was upsized from where traders had expected it. And the increases were attended.
Yeah, upsize not just overall, but also on their indication that of how much of it was going to be pushed onto the long end, right?
Yeah, the Treasury was more aggressive than expected in extending the duration of those issuances and upping the 10s, 20s, and 30s maturities in this upcoming refunding. And the announcement actually
John,
was
I have a question. How normal is that to have a significant upsize in a funding? How does this whole process happen? So when we knew that they were going to sell 30s, how long ago did they tell the market that it was coming? And then how rare is it to have a significant upsize to it?
Well, the refunding announcements, it is a quarterly cadence, and the degree of upside surprise is, I think it's in the bounds of pretty conservative guardrails here. The Treasury market doesn't. The Treasury Department isn't in the business of shocking the markets, and so and everybody knew that the sizes were going up. That was no secret, and so there was a degree of surprise, but it was hardly a jaw dropper when they came out with those numbers. And actually, the announcement of this latest refunding was taken pretty well. Yields, edged higher on the long end, but it really wasn't a major reaction. And we came into, at this time last week, 10-year Treasury yields were closest to they were near cycle lows. They were near their lows of March. And it was really, this auction needs to be put in context of what's transpired over the past week. And what has happened over the past week really has been a variety of different upside catalysts that sort of culminated in this not so great 30-year auction. And those catalysts really started at this time last week with an upside surprise in non-farm payrolls. There was, it was better than expected, but not just better than the consensus economists' estimation. That was also in contrast to what they called like the whisper number. Basically, traders were sort of bracing for a downside surprise in non-farm payrolls. Not only did they not get a downside surprise, they got an upside surprise.
In the last 3 months, we've created more jobs than Obama did during his entire presidency.
Apparently, yeah. No, not do the last one. I'll give them that.
Yeah, and that really sort of kicked off this latest uptick in the longer dated Treasury yields, which had been absolutely flat on the floor, as we said, and volatility had been super low. So it was really that non-farm payrolls last Friday, and then coming into this week, the uptrend was sort of continuing on Monday, but the the yields were supported on Monday. But on Tuesday, we got this dynamic where the Russian health ministry announced that it had approved a vaccine, and the markets react. Now, it's not as though markets really believe that this vaccine is going to work or is well tested and reliable and can be rolled out on any sort of meaningful basis. But it did have an announcement effect, and the fact that Putin and company jumped the gun here is kind of a signifier. It's a flash forward event to what will inevitably be more credible vaccine announcements by Pfizer, by AstraZeneca. These are coming. We know this is going to happen. Yeah. And so the market reaction was similarly, I think, kind of a flash forward to one of these more credible vaccine announcements. Yeah. And so we saw a lot of the pandemic trends, the very, most prominent market trends that have been basically ongoing throughout the pandemic, which is outperformance of tech stocks, 10-year, very, very low and flatlining Treasury yields, and precious metal upside. We saw those reverse dramatically, and I think that really was sort of a foreshadowing of what a credible vaccine announcement might do on a more durable basis. And so that obviously kept the uptrend in Treasury yields going. And then we got kickier consumer price inflation data, producer price inflation data in the U.S. We got considerably better than expected initial jobless claims. And then that culminated really in and that basically led into that 30-year auction. It was a mega size, $26 billion. And it was a little rocky.
Yeah. And going back to the inflation, the inflation numbers were really interesting, and it's going to create a little bit of a conundrum for the Fed, because all the stuff that we stopped buying, the prices went down and it bounced back. It was a little bit more of a math thing, because it went down so much that, on a monthly basis, it went back up. And that kind of overwhelmed everything else. So we had upside surprise. But the housing component in the CPI was actually quite weak, and that's showing rental deflation. And for all the data that we're seeing from the big cities, like New York City apparently has double digits vacancies, right? You guys did some work on that, right, Tony?
Yeah, exactly. I'm trying my best to bring that number down. 14,000 vacancies, which is a high going back at least a decade, I think. So it's a big number. So a lot of volume here available.
And that's how they measure how much your house. It's called OER, owner's equivalent rent. So they don't measure how much your house is worth. They measure how much you could rent your house for. So for the foreseeable future, while the pandemic's still going on, we'll have deflation in the rental component. And that's with the CPI, it's as much as 40% of the core and 20% of the PCE. So I guess you have to decide whether you want to target that, because it's a quirk that's been created by a pandemic. It's not normal monetary reality,
Yeah, we had a couple of things also on the just on the Treasury market and specifically on the auction. I mean, we're not seeing more growth on the Fed balance sheet. So, are they stepping away as a buyer? And we saw primary dealers having to take about 28-30% of that auction and on their books. Is the Fed stepping back as a buyer in these markets?
No, the Fed's purchases are basically on a steady course. They have committed to a minimum of what is it, Brendan? Is it 80 billion a month?
Yeah, it's slightly flexible, but it's around 80 billion.
Right, and the balance sheet, the movements in the balance sheet have been more about swap lines apparently than they have been about the regular cadence of purchases in treasuries and mortgage-backed securities. So they're in they're in the second, and the Fed is, and it's an important distinction. Unlike the Bank of Japan and the Ministry of Finance in Japan, The Ministry of Finance doesn't issue their debt to the markets. The Bank of Japan buys it directly from the Ministry of Finance. So it never hits the bank balance sheets, whereas the Fed still buys in the secondary markets.
Huge point. Yeah. So, there's a little steepening of the yield curve, though. Speaking of banks,
yes,
good for banks, right?
Yeah, that's how they make money. They take your deposit, and right now they don't pay you anything. I read a tweet or something the other day that was saying 15 years ago, if you had $100,000 at the bank, they just gave you $5,000 a year. They do technically pay interest, but not really anymore.
The bank stocks have had a decent month here. They had their,
and that goes back to your rotation. The tech stocks are the growth stocks, and the banks are now kind of the value stocks. So any hope of increased economic activity is very good for the bank, both because the yield curve is going to steepen and theoretically people are going to take out more loans and do more economic things.
We are going to look at it again. I mean, we did see for a couple of reasons, which and we can take a minute on. But we're going to keep an eye on this. The Treasury's got a 20-year next week. That's pretty sizable too, about $25 billion, I think, coming up next week. So we'll see how the market absorbs that, and I think we just keep taking the temperature on this and see what capacity is for it. Let's take a quick break there, and we'll come back on the Macrocast after this break.
Every 2 weeks, HPS measures U.S. adults' feelings and expectations for the economy. The HPS Civic Science Economic Sentiment Index accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us through HamiltonPlaceStrategies.com.
All right, we're back on the Macrocast. We're going to be filling this pipeline even more. I know there's some, views as to whether there's going to be another COVID relief bill. I think that's right. There will be a COVID relief bill. There is going to be a lot more financing, greater financing needs for the government.
Yeah, and that's an important point. Kind of going when we were talking about the Treasury market, the muni market, the municipal debt market has been showing some stress.
Yeah, I wanted to get into that. What are you guys seeing in that? New Jersey, I know, is in a. So the Jersey legislature approved, what was it, about $10 billion, $9.9 billion in new debt, and the Governor Murphy said that if they didn't have that, or they don't get a more federal money, they would have to lay off about half of their workforce, which would be 400,000 people, and I think Jersey's probably one of the worst, most dire situations. But that's fairly true across all states over the next 6 months. Are we seeing that with other states? I mean, on their ability to access the market right now. We also got some news this week of the Fed tweaking its municipal bond lending facility to try to be a little more helpful. But look, this has been one of the arguments of the COVID stimulus, which is Democrats out looking for more federal, direct federal support for states. Republicans saying the states don't need it, and anyway the states can borrow money themselves. Why should we borrow it for them? And without trying to solve that argument, my question is, how healthy is that market for states? And is our states and municipalities, are they having success in accessing these markets?
So far, so good, right, John? But it's
the commentary that we've seen. Yeah, this week hasn't been great very much like the Treasury market. The muni market hasn't had a terrific week, but the access to the market has been improved enormously with the Fed's right. Liquidity injections and the backstop. We've only seen Illinois tap that backstop. And, with these programs, there's always that stigma attached to it. And I think it's the onus is on policymakers to try to break through that And the Fed is clearly, they keep twisting the dials and knobs here, and the decline, the drop in interest rates to make this municipal lending facility more attractive, or to meet the market in a way, I guess, as conditions kind of come up to them, and they come down to the market conditions, there'll be more potentially more uptake. This is a program that's designed to be tapped. And I think municipalities here facing these kind of realities of job cuts like New Jersey, I mean, they should be engaging with the Fed. The Fed should be engaging with them to try to find ways in which this program makes sense in being a stopgap. Illinois, the situation in Illinois, they funded themselves at a full point cheaper than they would have in the muni markets, which is a meaningful amount. And so this program could be a difference maker, but it obviously isn't there yet.
So is the Fed allowed to buy just a bunch of specific, like, of this $10 billion at Jersey? Could the Fed take down half of it, or they just have to buy across the spectrum?
I think it's an individual. It's basically a state by state application.
So it is, okay.
To the Fed. They go to the Fed program for funding.
Yep, I get you.
And the Fed has all kinds of criteria about what kind of, states obviously qualify, but which municipalities. But unlike the Main Street lending program, the credit worthiness is less of a consideration, because Illinois is the least, it's got the worst credit among all states. And if they're in the program, then pretty much everybody else would be able to as well. The questions have really been about, what size municipal. They've toggled the different sizes of the municipalities that might apply, and now they're beginning to modulate the interest rates. And they're trying to find a formulation where this is going to meet the market going forward.
Yeah, to me, it's in a way like the Main Street lending program, which is like, it's the dead horse that I keep beating, and so I don't want to go into it too deeply. But if the market is not taking up your facility, and that there are severe problems out there, the problem might be with the facility.
Yes.
And it's like you're creating a hole that is just too small. If you create this a $500 billion lending facility to help municipalities and states, and you open your doors and only one customer walks in. Like, I don't know what the right number of customers is. I don't know what the right number of lending is. I know that
more than one.
One is not the right answer, right? One is not right. It's going to be more. It's a number greater than one. So some tinkering, at least. I would recommend something more dramatic. And by the way, I would think about ways to, if I were king, I would think about ways to tie it into some of the federal assistance. Where you could tie some borrowing, do some shared federal granting and borrowing, so that you blend the resources for states, and in that way they could make some decisions that are that are more. It's a more market-based decision as to how much money you're taking in, grant money, and how much you can you may want to try to access in private market, or whether a facility like this or private markets.
So I guess on that front, in terms of the negotiations on the Hill, what's your tea leave reading on how this is going to end up?
I think I've tried to say this. I got a note this morning that kind of set me off a little bit and had me put a couple tweets out on it, because it was a note that essentially said, well, it's over. There's not good. The hopes for a COVID relief bill are all but squelched. No one should expect a COVID relief bill. And I think that is absolutely the wrong guidance. Now, if you're just trying to create drama, say all is over, and then who was it who came off the bench in the 71 NBA championship injured? I can't remember who it was now.
Oh, for the Knicks, yeah, he had a broken leg. Bernard King.
You want the hero
Yeah.
coming off the bench, to save the game. That if you want that drama, great. Talk about it all being over. But there are a couple things that we know for certain. One of them is that the government runs out of the authority to spend money at the end of September.
It's an important point.
That's an action forcing event. You know, when you not allowed to spend money anymore, that focuses the mind on solutions and gets people to the table to start negotiating. And there's a whole lot wrapped up in that. That's the end of the fiscal year. There are big decisions that they have to make, not just with stimulus, but also on the budget going forward. It probably makes sense. It makes sense it makes sense in congressional negotiating terms to get these negotiations into September. It makes absolutely no sense for, citizens waiting for PPP funds or for, the macroeconomic impact of, $1,200 per person checks that might come in. It makes no sense for, places that are trying to reopen and don't have the liability protection they say they need. It doesn't make any sense for schools that are, hoping to open in September. So it doesn't make any sense in the real world, but it does make sense in congressional negotiating land to get those two pieces, COVID relief and the budget, closer together so that you can combine those negotiations. So there will be a bill. I don't know what the right number is. I still think it's going to be a number bigger, greater than $1 trillion and probably less than $2 trillion. And I think it gets done, before the end of September without a government shutdown. It would, for it to go beyond September means we're going to see a government shutdown. And absolutely nobody sitting in, federal elected office today wants to see a government shutdown. That's not a recipe for success on election day for anybody. So that's that's my bet. We're going to get it. It's going to come, and I think the market is, market participants are absolutely right to expect it's going to come.
Yeah, there are a couple of must-haves. We talked about this in a previous show. The Senate Republicans must-have is that corporate liability limit for COVID. That's a must-have that isn't anywhere. Obviously, they can't do that through executive fiat. And the Democrats clearly have a must-have number for state aid that's higher than it is right now. The White House, everybody, the lack of impetus to get it done in August to some extent was because of those stopgap executive orders that President Trump put out last weekend. But everybody knows that there's a lot of questions there around the execution and feasibility, viability of those orders. But also, as we've mentioned a number of different times, the markets aren't really holding their feet to the fire. And for a White House that takes the S&P 500 as a daily opinion poll on its a referendum on its basically on its functioning, the message from financial markets is you guys are doing fine and everything's okay. And that's a very superficial viewpoint, a very narrow viewpoint, looking at S&P 500 index levels. But that really is, in a lot of ways, how the message from the markets gets through to top policymakers, particularly this, equity obsessed White House.
Yeah, and let's face it. We're not going to see that sell off. I don't believe, and it's it is dysfunctional that we have government that requires those kinds of things to get any kind of action, or they need to see realized pain by their citizens rather than just predicted pain by their citizens in order to make things happen. So but that's like I said, that's the government we've built for ourselves. We have to live with it, and we shouldn't be surprised by the way it's going to play out. But I think that's the way it's going to play out. I think we will get it done. At any rate, they've all gone home for the summer. And so, so it's not just unlikely. I think it's impossible to get something. They said that call people back at any time, and of course they can. They can do that anytime. But we're not going to see serious negotiations and action on this until probably the second week of September. Let's come back and take a look at what's happening next week. You're listening to the Macrocast.
Markets Policy Partners provides sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com or visit them on Twitter @marketspolicy.
All right, we're back on the Macrocast. I think I mentioned that we've got, we do have some, Treasury market action next week we're going to be paying attention to. What else is out there, guys?
So we have a lot of U.S. housing data, which, as we've said before, has kind of been one of the bright spots in the economic recovery for America. And then we get all of the market PMIs, both the manufacturing and the services, which have been showing a global rebound. So everywhere from China to Japan to Europe and the United States.
Hey, Brendan, on housing, we saw with a little bit of backup on Treasury yield, just like a little, some tick up. These rates are still really low.
Yep.
But we have seen mortgage rates, back up a little bit. We saw, the federal, I can't remember what it's called now, but the regulator of Fannie and Freddie.
Oh yeah, FHFA. Yeah.
FHFA. Thank you. I still remember the old one. So FHFA, Federal Housing Finance Agency, is requiring Fannie and Freddie to, add another 0.5 percentage point to.
Their fees, and that's going to pass directly through to the borrower. So I think that's a really, really important point. Some of the rebound in housing was people escaping cities, but a lot of it was just normal activity because rates are so low. People are buying houses. So basically every mortgage that's not a huge jumbo, which means a large mortgage, is bought by Freddie or Fannie or underwritten by the United States government. So to increase rates that much, both the market is pushing rates up a bit, and then you're going to tack on another 50 basis points to that. Yeah. That has that's a big risk to the housing market, a big risk.
And I think Treasury and the White House perceived it as such too. I think that they've expressed their disappointment in that decision to some reporters, and it'll be
So I guess this was Mark Calabria. I guess is kind of doing it on his own. So they're trying to privatize Freddie and Fannie. So I think he makes all his decisions based in that spectrum, isn't necessarily looking at anything else that's going on in the world. So in that front, you have to, if you're going to privatize them, you have to make them profitable. And one way to make them profitable is to charge more fees.
Use pricing power. Yeah. Anybody who knows Mark Calabria and has known him over the years should not be surprised by this at all.
Right. Yeah.
Yeah. But that doesn't mean that they were happy about it. And it'll be interesting whether it stands. He is a Trump administration appointee that is supposed to be an independent, regulator. It's housed within the Treasury, but it's an independent regulator. And, we've seen the White House and Treasury, express their views with the Fed in the past on Fed, policy rate decisions, but it is kind of unusual to see them express, disappointment in one of their regulators.
Yeah.
Like this. So,
and there's been a lot of lawsuits over the privatization and of the government taking over Freddie and Fannie, but within a couple of those rulings, it was ruled that the White House is allowed to replace whoever the FHFA director is. So Trump technically could fire him. Yeah, and the same with Biden. If Biden was elected, Biden can get rid of him also.
Yeah, he certainly could. And full disclosure on that, Hamilton Place Strategies represented firms involved in that in at least one lawsuit on that particular issue.
Yeah.
So, yeah.
Also, next week we get the Fed's minutes from the July meeting. Pretty, it was a pretty straight down the fairway kind of meeting. They kept policy settings steady as she goes, but they hinted additionally about what kind of policy pivot they might be executing come the September meeting. As early as the September meeting, it seems, is most likely. And the expectation is for enhanced guidance, as we said, which is basically seems to be based on the statements coming from Fed officials, in effect, a more express and more overt linkage between their inflation targets and full employment mandate to rates policy and quantitative easing trajectories. And so we'll see how that plays out. We'll see if the minutes come up with anything that's more definitive on that front. But they've been pretty cagey about it, and we'll see what goes from there. So
yeah, and hopefully we get a little more color on what they talked about, especially with the Main Street lending program, if there's plans to tweak that further.
Yeah, I'm curious to see where that is. I mean, obviously, it's a the policy on that program. I keep it's housed at the Fed, and I take aim at the Fed, but that is a joint program between Treasury and the Fed. And,
yeah, and honestly, that's the simple solution. The Treasury just needs to take a bigger first loss position.
Right, simple, right?
Yeah, and then you can loosen your underwriting standards and make it a little bit more like PPP and less like a strict loan from your local bank.
Yeah, I guess at the end of the day, they have to make a decision as to whether they can have any portion of that being grant. You know, and I think you need it to have it be forgivable or grant-like. If you want any of these businesses to take it up, if you're a business, you don't know when you're going to get back to normal economic activity. You're trying to, keep the lights on and your operation going so you can get to the other side. And incurring debt in that situation is a really tough decision.
Because right now, basically, you can get the same loan from a bank. So if you're too weak, the bank's not going to make it, and also the government's not going to make it. If you're in a position where the bank will make it, you would much rather take it from a bank than the government, which can then impose restriction on you. You don't really know what they can do to you, but you have to pay them taxes, so that they have an easier way to get back at you. What they need to do is make it looser so that you can actually get money in the hands of businesses that need it.
Yeah.
Also upcoming over this next week is the U.S.-China Phase 1 trade deal.
Oh, important
call.
point. Yeah.
So this is something that was announced pretty recently, and there was a sort of heart palpitations in the market. Oh my gosh, we're going to be revisiting, reopening, relitigating perhaps the Phase 1 trade deal. My gosh. And this is in the context of, continued U.S. efforts to counter China on a variety of different fronts. Most recently, the announced upcoming bans on WeChat and TikTok. The Chinese negotiators and Chinese officials are obviously going to raise that in this call. But the Trump administration, despite the fact that, you said it's been poking the dragon and establishing a tough on China line going into the election, has respected a variety of different red lines, things that if they, they've obviously been pretty aggressive, but haven't crossed particular lines that would draw, a potentially self-defeating, ferocious retaliation from Beijing. One of those red lines has really been the Phase 1 trade deal. If the Trump administration rips it up, then the markets are going to go into a, major spasm. And so we think, and the atmospherics, President Trump has made favorable comments about Chinese farm purchases over the last day or so. So they're going into this with kind of a positive spin. Lighthizer and Mnuchin are the point folks on this, and they've been very protective of this deal. We've seen that before when President Trump came out in May and mouthed off about potentially repudiating it, and they came out and did made some public statements about how well it's going. So this we think is probably going to be contentious, but the Phase 1 trade deal will carry on, and the Trump administration still boasts about this as one of their major accomplishments.
They do, and there's a little schizophrenia here, right? I mean, depending on which topic you raise with respect to China, if it's whenever you hear the president asked about the trade deal, it's glowing in in his responses, and if you talk about COVID, they're the most despicable, people on the planet, and so it's a weird situation. I don't think it's a particularly healthy situation, but I don't think anyone should worry about the trade deal being disrupted. That's I think there's a lot of pragmatism going on with the trade deal right now. Yeah. All right, guys. One thing we didn't get into this week was politics. We missed we didn't have time to talk about Kamala Harris being named as the vice president with Joe Biden, but we'll get into that next week. We're going to have conventions to talk about. It's still going to be, we still have dog days of August to get into good politics, and so I look forward to getting into those subjects next week. But have a great weekend. We'll catch you next week on the Macrocast.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.